The Australian share market recorded its fastest decline in history in March. The market fell by 40% from $7,197 all the way down to $4,403. A huge 40% decline, but then it was followed by the fastest bull market in history, rising 40% to approximately $6,127. In this video, I'm going to go over why the share market dropped so rapidly, why it's risen so rapidly, if now is a good time to invest, or is it all going to come crashing down again. If this video brings you value, please like for the holy YouTube algorithm. And comment your thoughts below. Do you think the share market is going to keep on rallying, or do you think there's going to be a huge crash coming? And subscribe, because according to my YouTube analytics, 70% of you watching this video have not subscribed, which is unbelievable. So you better subscribe now for personal finance, savings and investing, property and economic news updates. Let's get into the video. So we're all pretty well aware of why the stock market crashed in March. Clearly, it was because of the current health crisis that is going on. There was so much uncertainty and the whole world was going into lockdown. Stocks were falling at record paces every day. The Dow Jones actually dropped 13% in one day. The ASX 200 nearly dropped 10% in one day. And if there's one thing the stock market hates, is uncertainty. But what has changed since then, and why is it now booming? The first thing you need to understand is the stock market is not the economy. Now, the stock market throughout history does tend to go up and go down depending on how the economy is doing, but never before has the economy and the share market been so distant. And I'll go into the reasons why. The first reason why is because of the mass intervention by the government and the Reserve Bank of Australia. Firstly, the government announced programs like the JobKeeper program, Job Seeker. They gave two $750 payments to people on welfare. They made it illegal to evict tenants. They also let companies trade while insolvent. And they also let people access up to $20,000 of their superannuation. And they guaranteed this new small business loan program of up to $15 in funding for small businesses, where the government will guarantee to the banks 50% of that loan if they go bankrupt. This has meant that in the past 5 months, there's been huge amounts of injection of cash and liquidity into the economy. But people have been locked at home, so they haven't been able to spend that money. So people have had more money left over to invest. And also they may have been at home bored and they think, oh, I need to figure out a way to make some money. And then, they watch a YouTube video on how to trade stocks and they think they're the next Warren Buffett. This has meant there's been huge amounts of new retail investors entering into the stock market, buying up bankrupt companies and betting big on these companies that are probably going to go out of business. Now also the banks have done their part too, by not only letting customers defer their mortgage repayments, but they're also letting small business defer their payments and even letting people defer their credit card and personal loan repayments. This has meant that it's been very hard for individuals and companies to go insolvent or to go bankrupt. And once these current laws are taken out, we may see more companies start going into administration and we may see more personal bankruptcies come up. Now that brings us to the Reserve Bank of Australia, and we're going to get into how their policies have helped increase the Australian stock market. What they've done is they've reduced the cash rate to 0.25%, and they've started something called yield curve control. And that is where they buy government bonds to lower the yield on those government bonds to 0.25%. That means the government and banks can borrow at 0.25% interest. And that is why we've seen 3-year fixed rate mortgages drop all the way below 2% now. I saw a mortgage the other day on Rate City for 1.98%. It's getting crazy. It's nearly free money with inflation at this point. And this has really helped the government be able to borrow at lower rates and the banks to be able to borrow at lower rates and pass this on to customers. The RBA also announced in March they're going to start a $90 billion lending program to small banks so they can borrow at very, very low rates to pass that on to small businesses, because of course right now small businesses are struggling and they need cheap credit to survive. But really, if you're a small business and you're not getting much income, this program has not been that successful, and I think there's really only taken up about $14 billion of loans so far. Now, during March, there was a liquidity crisis in the banking sector in Australia and in the US. And the central bank started something called the Repo repossession agreements. And that is where banks can offer up collateral to borrow money from the Reserve Bank of Australia overnight or a week or 90 days. And in March, at their height, some days they were injecting $12 billion into this repo market so the bank could have liquidity to keep on lending. Now, since March, the economic certainty has become a bit more clearer. Companies are starting to release their earnings for the worst affected quarter, or so far what's been the worst affected, the March to June quarter. And they're, like I said, they're releasing their earnings, and we're starting to get GDP numbers. And actually in America, they had their worst GDP decline on record, falling 33%. Now, another thing you need to understand about the stock market is the stock market tends to look to the future or look at future earnings. So we may be getting all this data now, but the stock market actually priced that in March, and that's why we saw such a rapid decline in March, because investors were saying, I'll sell now, wait to see what the data is, wait to see what happens, and they're pricing in the worst case scenario then. And now we're thinking, well, you know, all this bad news is coming out, unemployment's going up, we're having the worst GDP numbers, you know, coming out. Why is the stock market coming up? And that's because the stock market is now trying to look past these numbers, because they price those in the 40% decline, and now they're trying to predict what earnings are going to be in the next 6 to 12 months. That doesn't mean the stock market is always correct in predicting what future earnings are going to be or predicting how the economy is going, but that's just what tends to happen. And that's why you may be thinking, why is it going up now when all this bad news is coming? And that is because in general, they tried to predict what earnings are going to be in 6 to 12 months, not what's happening right now. But you came here for the question, why is it going up when we're in the worst economic downturn in 100 years? Let's have a look. One huge reason why assets like shares, gold, silver, crypto is going up right now is because of low interest rates. And with low interest rates, people are able to borrow money cheaply and invest. And, you know, say for example, if they're getting a margin loan at 3.8%, then they claim the interest on tax. And if they're in a high tax bracket, you know, you can pretty much bring that interest rate all the way down to 2.4%. And then say if you factor in inflation, you know, your effective rate may only be 0.5 to 1%. And then if you invest that interest only, you know, into shares that on average return 7 to 8%, some people that have a high risk tolerance may think, you know, that's actually a pretty good deal. I'm not saying that's the best thing to do or you should do it. I'm just saying this is just a factor in why prices are rising. Another big thing with 0% or very low interest rates is people that have their money in the bank and say if they're only getting 0.5 or 1% interest on their money, they're actually getting a negative return, because the central banks are trying their hardest to increase inflation. And even though we've had deflation now because everyone's stuck at home and they can't spend, if they're saving right now, stuck at home, and you know they've been dying to get out, once the economy does open up, we may start seeing inflation start creeping up. So again, if you're getting 0.5 to 1% interest in a term deposit and inflation's 2%, you're actually getting a negative return of 1.5% to 1%. And this is forcing people to take more risks and put their money in the share market, where they think that, you know, inflation might get high, but normally shares tend to outperform inflation. Now, just like term deposits, a lot of investors that used to go for bonds for safe havens, but now even bonds like the 3-year government, Australian government bond is only returning 0.25%. So again, if inflation gets to 2 or 3%, you know, they're getting a negative return of 1.75%. So again, they're forced into riskier assets like dividend stocks to get income instead of bonds, or to, you know, get capital growth in equities. Now, another thing that may happen in Australia that investors may be speculating on is what they've actually done in America is their central bank, the Federal Reserve, has actually started buying individual corporate bonds. And what that means is a big corporation, they can issue bonds, aka debt, to investors and to central banks, and they may say, hey, I've got some bonds here, but no one wants to buy it because it's so risky. Well, the central bank has got their money printer, And they're like, yeah, I'll buy some of your bonds. And with the insolvency laws, that's made it very hard for these big corporations to go insolvent. And even companies that have a lot of cash, they're still issuing bonds like Apple and Amazon. And, they're just getting brought up straight away where, they may issue a bond and they'll pay 3%. So they're looking a lot more attractive than government bonds, even though they're a lot more risky. But investors really need that income. So they're starting to buy things like corporate bonds. And now that the Federal Reserve has started to buy corporate bonds, they're thinking, hey, if things go bad, the Federal Reserve will bail me out. And this is creating a lot of risk in the stock market. And this is really giving the investor that speculation that, hey, I'll put my money into these really high risk assets, and if things go bad, the central banks will turn their money printers on and bail me out. Now, one of the strangest things that has been happening in the market right now, with all this bad news is coming out, it's almost like good news now. And the reason why that is investors may say, oh, with all these really bad, scenarios that are coming out, that this is what's going to happen to GDP, this is what will happen to property prices, this is what could happen to the share market. And these companies are putting out these really bad predictions. But then what's that doing is scaring the government and scaring the central banks into action. So they'll say, look, we can't let this crash happen. And then they will announce some new program, or the government will start spending more money, or the central banks will start printing more money. And investors are now pretty much like, hey, bad news is good news, because if there's bad news, they'll print money. And if it's good news, all is well, and the stock prices should go up. Now, I must say there has actually been some good performing companies and have actually gave good reasons for their share prices to go up. For example, the S&P 500, the top 5 companies now make up almost 25% of the index, and that is Facebook, Amazon, Apple, Microsoft, etc. These companies are getting bigger and bigger. The big corporations, the mega corporations are getting bigger, and small businesses are getting destroyed. And those few companies that are going up are actually making the whole index going up because of the weighting of those companies in that index. Not only the big tech stocks are going up because of everyone's at home and people are shopping online, but also there's been a lot of speculation into healthcare stocks because they're considered safe havens, and if one of these healthcare stocks create a vaccine, then obviously their share price is going to skyrocket. And recently we've seen mining stocks skyrocket lately purely because the gold price has gone up. So investors are speculating that these gold miners will become more profitable, and even Warren Buffett has brought into some of these mining stocks. Now, the energy sector, on the other hand, has been the hardest hit because there's a lot less people driving on the road using fuel, and there's a lot less planes in the air using fuel. So you want to know why the stock market has been going up? It's because of everything I just said. Huge amounts of government stimulus, huge amounts of money printing by central banks, the currency actually being devalued. So the share price may actually go up. That may not be because the company's worth more, it's just because the currency that stock is valued in is worth less, like the US dollar and the Australian dollar. Again, 0% interest rates is having a huge effect on why the stock market is rising, because people that used to keep their money in the bank and get interest, or people that used to have government bonds as a safe haven to get interest, are now forced into securities like stocks and equities to get a dividend or to get returns on their capital. Also, we cannot forget the Robinhood traders, the retail traders that are coming into the market right now. Really, all you have to do is go to work. I'm sure you probably notice your colleagues are starting to talk about shares more now. Your family may be talking about shares more now. And that is a reason why more people are getting into it, because everyone's talking about it. It's the next new thing. But one thing to note is professional investors, aka the big hedge funds, have actually been net sellers of stocks. Now, you may ask yourself another question is, will the stock market actually crash again? Well, the only thing holding up the stock market right now is a government stimulus and the central bank's money printing and these retail investors. Now, a lot of them have already put in their money. A lot of the central banks like the RBA has admitted, we've done everything that we can. We don't really want to go into negative interest rates, and we don't want to do any more helicopter money. So if all this is withdrawn like it is being withdrawn right now, the central bank's buying less bonds, the government is reducing JobKeeper and JobSeeker and withdrawing stimulus there. And if the real economy does not recover, we don't get that V-shaped recovery and people don't start spending, unemployment's going to be high for longer, the economy will be affected for longer, there'll be more scarring, and there may be a second stock market crash. If things aren't all doomsday, if things aren't all pessimistic, and things do get better, the restrictions do get eased, we get a vaccine, everyone goes back to work, a lot of people have been locked up, they haven't been able to spend money, and we could actually see a good, growth in the economy because people want to start traveling again, people want to start going out again. I know for me, for one, I've, been pretty annoyed being here in Melbourne in lockdown. I can't wait to go on a holiday. I can't wait to go see my friends and go out with my friends. So if things do go good, that may help the economy a bit. And again, that may help the share market a bit. At the end of the day, nobody can predict the market. All this is speculation and just taking in the fundamentals and trying to make the best educated decision you can and make the best investment choice you can. I don't think anyone could have predicted without saying, hey, next year we're going to have the worst recession in 100 years, but don't worry because the stock market will be at all-time highs. I don't think anyone could have predicted that. If you're a long-term investor, this is not financial advice, but you should just stick to your plan of investing, every month, every 3 months, because nobody can predict the market. Yes, it may be at all-time highs now, but if you just keep buying, who knows, it could go higher. And hey, if it crashes, then that's a good buying opportunity. Alternatively, if you're a doomer and you think everything's gonna, collapse, maybe things like gold, silver, even Bitcoin may be good investments for you, because if things do go bad, they do tend to rise in uncertain times like we've seen so far. If you really think that the economy is going to collapse and society, everything's going to be really bad, well then I wouldn't even buy gold or crypto or Bitcoin. I'd actually be going out into the bush. I'd be buying a farm, I'd put solar panels, I'd make off the grid, I'd get water storage, I'd get animals, and I'd be living a self-sustaining life. And hey, I don't really get why people say, oh, everything's going to collapse, so I'm going to put all my money in gold. Well, everything collapsed. That gold's not going to feed you, that gold's not going to protect you. So hey, if you're really a doomer, you better start, going out the bush and creating an off-the-grid house for yourself, and you can live that nice, peaceful life. You don't have to worry about all the craziness going on in the cities. If this video brought you value, please smash the like button and comment your thoughts below. Do you think the stock market will keep rising, or do you think it's going to fall? Do you think that we should invest in stocks or gold, or do you think we should move out in the bush and create an off-the-grid farm? And subscribe for more awesome content on stocks, personal finance, savings and investing, property and economic news. I'll see you in the next one.